So welcome to this Endeavour Connect event with DAI Magister and Victor Basta. My name is Antonia, I'm the Capital Markets Lead, and it's with great pleasure to welcome Victor here today. A year ago, Victor was in Cape Town in person, doing a small cohort to a group of our Endeavour entrepreneurs. And this year, a year later, a lot has changed, and one of those changes is that we are here having a virtual event. So, yeah, we have got participants from Endeavour entrepreneurs from multiple offices in Africa and the Middle East, so Kenya, Nigeria, UAE. So welcome, and welcome to our investors. We've extended this also to our investor network. So it's really great to be able to do that. So welcome, morning if you are in New York, which is where Victor is sat right now, and afternoon for the rest of you in the more of the Southern Hemisphere. So Victor's got a long history with Endeavour. This is an invitation-only event, and really the focus and intention is on capital raises, but a focus on exits. So things have moved really quickly. We need to know how to prepare for exits, and focusing on the end really allows you to know where to spend your resources. So Victor's really going to take us through the current state of the growth financing, planning for larger rounds, and quickly moving on to both exit preparation and successful exit preparation and pitfalls to avoid. With that, just in terms of logistics, if you've got a question, please use the Q&A and I will relay that question to Victor and hopefully get your question answered. But and do that as we go along. We'll keep it like that. Please, if you would like the presentation, and also if you'd like to get hold of Victor, just let me know or give me your email in the Q&A and we will do that. Great, thank you.
Great, thank you. Thanks, Antonia. So, yeah, I've done a few of these events before, and they have focused on raising larger rounds. And this event is different in its focus. There are a number of people, I think, joining this webinar who would have sat in on one of the previous events that I did. This really is focused on exits, and particularly on exit preparation. We'll talk about why that's much more relevant today than it's ever been for the region and the continent. And also, it's actually something that I've done for almost 30 years. So some of you will know the work that we do in terms of raising larger rounds, but I've done 120 exits, I think, on behalf of companies, tech-enabled companies over the last 25 or 30 years. So I have seen almost everything, I would say, from that point of view. The other thing also is that I taught exit preparation at INSEAD, the business school, for 6 years as an adjunct professor. And so a few of the slides that we're going to go through are extracted from the material that we developed in the course of a few years teaching the class. I actually have put all of it together into a set of files that could eventually be a book, but it's not available on Amazon and it won't be anytime soon. So this is kind of the only way that I can share that with all of you. And as I said, we'll talk about why it's so topical. One of the interesting things is that since the last time that I had spoken to any of you, we've done our own exit. We sold the majority to a company called DAI, which is a large consulting firm some of you will know. We are their play in the corporate finance advisory space, and so their objective is to build around us. But what is particularly relevant, I think, for people joining this call is that it naturally moves our focus even more towards working in emerging markets, even more towards working in Africa and Middle East. We still are doing a reasonable amount of our work and will always do in Europe and the US, but our center of gravity, if you will, which was anyway focusing towards the continent, has just kind of accelerated from that point of view. And so it gives us the resources to double down. The other thing also, and I was asked to give a little bit about us, but just one thing is, as some of you will know, we've been spending time over the last 3 or 4 years up and down the continent beating growth companies, which is really the group that we focus on, and to the point where we're now working on 3 exits on the continent and 6 larger financing rounds. And I know for sure there isn't any other advisory firm that's doing this sort of volume of business up and down the continent. So, of course, it takes years to be an overnight success, and maybe this year will be an overnight success. But the point is, we've made a commitment. I'd say we're all in. And so this kind of discussion, from my point of view, to be as helpful as we can be to companies that are either considering seriously potential exit or are starting to think about it. What does thinking about it mean? And more importantly, what does preparation mean? So let's get started. I think some of you will know that from our point of view, preparation is everything. And Abraham Lincoln's been quoted an awful lot in the news over the course of the last few weeks, particularly in the United States from all sides. Just one of his quotes, probably, frankly, I would say you'd spend the first 5 hours sharpening the axe rather than 4, but the point is made. Success in exits is won or lost during preparation. Preparation for an exit is different than preparing for a large round. It's about a 70% overlap in terms of the activities, but maybe 60%. But there's a chunk that relates to exit preparation that is different from a large round. And what we're going to see actually over the course of the next couple of years is more and more companies looking at dual track, which is looking at M&A exits in parallel with raising larger rounds. And I talk about exits and M&A interchangeably. Of course, Jumia went public and Fowry went public, et cetera. So of course companies go public, but of the successful exits across venture portfolios, probably 80% year in, year out are M&A. And the other stat, which some of you will find surprising, is that for tech-enabled businesses, within 5 years of going public, 50% of them either merge, go out of business, or change their shape entirely through some kind of external transaction. So M&A is a fact of life in the tech-enabled sectors that we operate in, even after companies go public, but certainly before. Largely, M&A equals successful exit. And so we do talk about those interchangeably. So some key messages. The markets are, I said, quote, unbelievably high. We are, I forget, 12, 13 years into what should be a 10-year cycle. Everybody has said for a while that we are overdue for correction, and yet there is no better time to be selling equity in any form in tech-enabled growth companies than today. There is no better time to be selling equity in African or Middle East tech-enabled companies than today. This is not a discussion of macroeconomics, but from our point of view, they are, quote, unbelievably high, and therefore have to be unsustainably high. Gravity has not been suspended indefinitely. What we are starting to see is M&A accelerating. And also what's happening more and more is that in larger rounds, $25 million plus equity raises, or $30 million plus equity raises. Yeah. In those larger rounds, a growing proportion are secondary sales. And we see early stage investors also in Europe quietly grumbling because their best companies can raise and raise and raise. And their view of a 5 to 8 year clock to get a reasonable amount of liquidity keeps getting stretched further and further out. Product of the amount of dry powder available for Series C and D stage companies. And so those early stage investors are actually looking to exit during these financing rounds. And so now, I would say 5 years ago, the proportion of secondary in a Series C was 0 to 10%. Now we're regularly seeing 30%, 40%, and you can even get up to 50-50 in certain cases, even in a Series C. And so it creates a path to liquidity that's separate from an M&A exit, albeit arguably it's always going to be at a bit of a discount to a strategic deal, but at least it's a path to liquidity. So those are being used interchangeably in the current market as a way to play the fact that the fundraising environment is so strong and markets are so strong. Point three may be counterintuitive. There is no better time to prepare for an exit and be exit ready than when valuations are extremely high. Usually people behave the opposite. You know, markets are up and to the right. I can keep raising, and I'll just worry about an exit later. Now, let's just do a quick reality check. There are a whole range of companies with ambition in Africa and the Middle East to be worth $1 billion plus. It's unproven. Doesn't mean it's not going to happen, but it's unproven. And so for a very large proportion of those companies, they're in position to get a very attractive exit, but at 100 million plus or 200 million plus. The other thing, of course, for CEOs and investors that are earlier stage on the call, everybody knows the calculus, which is you keep getting diluted and diluted and diluted. And so you have to be playing for a 500 billion plus exit. That's not the natural rhythm of the market. I mean, DPO was sub 300, Paystack was 200. You know, those are the kinds of deals. One of the deals we're working on is a bit bigger than that, but 500 plus is not yet proven and won't be for the next few years. And so it really does focus everybody's mind on, if we're going to be raising at 150 pre, that's usually a time to think also whether an M&A exit might also be possible. And so being exit ready, and of course, the value preparation is rising as a result of that. One of the issues, though, is, well, what does preparation mean? What do we do? Yeah, it's great to hear the word, but like, what do we do? In the year before, year and a half before? Let me just take a second and address some of that. There's no point doing exit preparation if it's 3 years out. I mean, you can be thinking about it, planning ahead for it, but you know, things will change. Certainly within a year of the company being eligible for an exit, preparation should start. And the idea is not to exit at a certain point in time. It's the height of hubris to think you can press a button and exit. It's to be exit ready. For the company to be on the radar screen of buyers, naturally in the conversation, people who are looking to do deals in a space are familiar with the business, know the team, etc., and the company is front and center of mind, and underneath is exit ready. And so it can react to opportunities when they come. The objective is, in exits, is to be bought, not sold. The dirty little secret is that being bought, not sold, requires a fair amount of selling beforehand. You just don't call it selling. Okay, let's go on. Now, there's a natural rhythm to why there's going to be more M&A. I'm going to pick up speed here in a moment. So post-COVID, M&A is going to naturally rise. You see here on this chart, this is the ratio of exits to fundraisers. For the statisticians on the call, you probably appreciate the distillation like this. Dot-com crash, financial crisis, and then the period post-COVID. Shaded period is post a downturn. And you see the ratio obviously favors M&A for some period of time. We haven't seen it yet, but we haven't yet entered the post-COVID period, which hopefully, knock on wood, we will do this year and next year. There will naturally be M&A that happens. Now, you may wonder, oh, okay, this is companies that have to get sold that have suffered through COVID. And the reality is, for the most part, that's not the case. Of course, you have some. What happens is that investors, and then also CEOs and founders, they have a different calculus about the trade-off of liquidity and risk. Things are going up and to the right. Many people on this call probably haven't really experienced in their current companies a sustained downturn or the economic aftershocks of that. And usually that encourages people to think, well, hang on a minute, liquidity, cash really has more value than it would have had if the markets were unilaterally going up and to the right, both the end markets as well as the financial markets. Here we have a disconnect where the financial markets have gone up and to the right. Economic growth over the next couple of years, question mark in certain geographies, and actually creates that arbitrage where selling equity for, quote, more than the company is worth based on its near-term forecast certainly can apply. Not for everybody, but it certainly begins to apply. And that's why we've seen in the past deals happen post these downturns because of the change in mindset, the change in the calculus. So that's the overall. Let's keep going. The other overall thing is that on the right-hand side, this is investment funds dry powder, not the fund sizes, but the amount of dry powder they have. You'll see, if you can read this, that there's 300 billion of dry powder. By the way, we're excluding large buyout funds. We're talking about funds that would apply to growth companies on this call. Of course, not all of it is aimed towards the Middle East or Africa, but that's the sandbox that we're playing in. Now, the interesting thing is that is 3 times what it was just a few years ago. So the amount of dry powder is also a function of how much has been raised. There's a lot of money. There's also a lot of money on the bottom left in publicly traded tech companies. This is the total cash balance of the top 100 public tech companies, and it is $1.5 trillion. Not billion. If you go back a second, Dorian, sorry. One thing, though, I should point out, these are actually not the companies that do most M&A. Everybody thinks Google, Facebook, et cetera, will do acquisitions. If you actually look at the number of acquisitions those tech majors do, it's actually not very many. And if you actually look at Google, other than YouTube and a few others, most of their deals are sub $50 million. Acqui-hires, buying capability. This is a little bit of a false positive. Of course, it shows you just the amount of total cash that's been generated by these business models. Those are not your buyers. The buyers are the much more prosaic tech companies doing $100 to $1 billion of revenue, US, Europe, and Asia, growing reasonably quickly, for whom a $200 million deal in a geography in an emerging market has real strategic value. Or they're global financial sponsors who are buying a business and building around it. Those are the people doing the deals, not Google. Makes exit preparation that much more challenging. Makes navigation towards buyers, of course, more challenging. You can't talk to every $200 million revenue potential buyer around the world for a business, but those are the people who do the deals. If you go to the next, we'll look at here quickly, how does this relate to Africa? Now, M&A activity in Africa is still developing, but it would surprise you, it certainly surprised us, the median deal size, this across everything, cement, technology, telecoms, everything. Yeah, not the average, the median deal size from the data set has actually doubled in the last few years on the continent. It's now running at $140 million, will probably go up to 150 million median, which means there's a fair number of reasonable sized deals being done in Africa where people are putting money to work in different sectors, generally. The other interesting thing is when you look at tech-enabled, and this is a fairly broad definition of tech-enabled, so it's not software only, but it's now over half of the M&A activity. And we're talking about deals, by the way, only above $20 million of value. So not $5 million M&A deals, which are salvage deals. Yeah, deals that move the needle for people. Of course, everybody knows about DPO and Paystack, and everybody's tracked every price movement of Jumia, but there's a fair amount of other activity happening elsewhere, more broadly, that is indicative of the systematic trend, how the continent overall is developing. And not surprisingly, tech-enabled businesses are becoming more and more attractive for all the reasons that have driven all of you to run those businesses. There's going to be a fairly active M&A market in Africa and the Middle East for tech-enabled businesses for the next 2 or 3 years. That's the takeaway. And so at a high level, anybody looking at preparing for an M&A exit is selling into demand. And from the previous slide, anybody doing preparation is also selling into a very high, arguably unsustainably high market for some period of time. The weather conditions, if I put it that way, for successful M&A in Africa have never been better. We go to the next slide. Now, this starts to get a little bit more detailed, and I think some of you will have seen versions of this, which is which sectors post-COVID are more interesting, which are less interesting. This is BCG, Boston Consulting Group's cut by end market and by type of M&A rationale. So it is indicative, but it gives an idea that in certain areas, and consumer goods is certainly attractive, and that really covers companies that are doing both distribution, logistics, delivery, manufacturing, etc. Consumer goods, of course, financial institutions, and then retail as it has had to shift online, and healthcare as it's had to shift online. So this is indicative of those sectors that have had to shift more online very quickly during COVID, and the online tech-enabled business models serving those end sectors have become naturally much more attractive post-COVID. To the point where actually we don't expect that this year there are going to be very many what I call salvage deals. Likely they're going to be M&A deals for people who want to buy a position in those markets, because as you know, legacy players in those markets have not done the transformation. It's startups that have filled the space. Go to the next slide. Now, let me shift gears from the macro to the specific. When I taught the INSEAD class, we developed a framework for looking at different elements of exit preparation. And that was part of the class. So you're all going to go back to or go to business school for a few minutes, so bear with me. But the reason that we did that was obviously put some structure around it. Why is that useful? It's not just to think about it, it's also because working with CEOs and boards on exit preparation, which we do all the time, it's very helpful for a CEO and senior leadership team to have a framework to think about. Exit preparation is about just execution of a project plan, if you will. Sometimes quietly, sometimes proactively and visibly. And like any good project plan, it benefits from having a structure and a framework. Now within that, and we're going to talk about 3 of the areas, and I'm going to talk about a few things in that. Within that, though, it's not make sure that your audit is up to date or whatever. That's not helpful for exit preparation. That's what I call hygiene. The useful thing, or more useful thing about exit preparation is what are the dimensions that you as a CEO or board member really ought to be thinking about. What could move the needle from value or certainty? And also there's a general theme, as you'll see, which is looking at the business from the outside in, looking at it relative to other players in the market, relative to other opportunities that exist for buyers to acquire. Because when people are looking to buy something, if I say the biggest mistake that the companies and CEOs make is they look at it, not surprisingly, from their own silo. That's not how buyers look at it. They don't care about your silo. By the way, they also don't care about your $20 million of revenue. For the most part, it's irrelevant to them. What they're interested in, if I can abstract, they want to know, how is this going to turn into a $200 million business unit within my business? And how does this stack up relative to other things I could put my money into, either internal projects or other acquisitions? And so in an M&A context, you're being evaluated, but you're also being compared. And so it's useful to think about it from those lenses rather than from the outside, from the inside out, rather. So let's just quickly look through. And by the way, as we go through, if you have questions, we have a facility for those questions. I wanted to run through the material fairly quickly, but please raise questions, and Antonia's standing by to ask them so that we can make this interactive, particularly as we now kick into this. So positioning. Books have been written about positioning. Most of it is not really very helpful. So a few things to think about here. One is, forget how you think the business should be positioned. What's the perception of key customers of who you are and what you stand for? It's very useful to think about it from their point of view. And of course, this probably more for enterprise customers than for consumers per se. But for example, on that dimension, certainly the work we do in Europe, people are constantly looking at online reviews, scores, ratings, etc. We have buyers going into Reddit threads and digging in Reddit threads to look at. We had one deal where the buyer looked at all of the sub-threads of a highly technical piece of software to get a sense of the real power users and what they thought of it. And that actually worked very well because that validated for them just how good the product quality was. But that's the work they were willing to do. The other, I'm going to pick a few of these from here, not read everything. The bottom left, how is an exit going to change the positioning, positively, negatively? Because buyers are thinking, okay, if I acquire X and that becomes my platform in Africa, because of who I am, is that going to change customers' perception of the business? Is it going to increase or decrease the value of the business? If, for example, a traditional legacy player bought a business that was tech-enabled in their space, is that going to change people's view of the company? And then also the middle top is useful. And then I'm going to move on to the next one, but the deficiencies that competitors would highlight. I can't tell you how many times a buyer arrives at an M&A discussion and they've already talked to two competitors in detail, or they've talked to other players in related markets who have a view. And I also can't tell you how many times scuttlebutt plays a part in buyers deciding whether to be interested or not. I mean, it is unbelievable. People will be more or less interested in writing a $200 million check based on what they heard from somebody somewhere. It sounds ridiculous. And of course, it's not like they will write a check because of it or not because of it. But perceptions are formed long before a buyer shows up to the table. A lot of the exit positioning is about informing or at least setting those perceptions. There's an equation I use, and I've used in previous Endeavor workshops: perception minus reality equals value, which is easy enough to get. Perception is not spin, as I've said on a previous workshop. It's what the buyer's thinking about the business, what their expectation is. They come open-minded, or they've heard problems. And very rarely, when they hear scuttlebutt that is negative, very rarely do deals convert. I can't tell you how valuable it is. So that kind of external perception before somebody shows up is more valuable than your data room by a factor of 2 or 3x. Business model. Everybody worries about business model and how it change. Picking up the same theme, you see the top left and the middle, the top middle, both follow the same theme of benchmarking versus competitors. I'll give you 1 or 2 examples. Gross margin is quite a tricky thing. There are companies in the same space, in the same continent, that calculate gross margin completely differently. or at least differently enough that you can't compare it. I'll give you one example. Sales commissions. Are they in or not in gross margin? Some companies have them in, which is the right way to do it. Some companies don't have them in and inflate gross margins. As a result, you start to give the perception of the business inflating things through small decisions like that, that bias buyers away from a business and actually affect the perception before they really dig in. Revenue mix is also very important. Far too many companies on the continent have far too many lines of business. There is usually a very quick simplification exercise to take the 7 or 8 things that you do down to 2 or 3 just by aggregating them. It shows simplicity. It doesn't change anything in reality, but in terms of just the perception of something being simple to buy, simple to manage and operate after a deal, those kinds of things can actually go a long way. As I said, there's rings of perception. There's a perception before the buyer shows up at the table. There's the perception after the first meeting, and then there's perception later on. You win or lose on an M&A deal really after the perception of first meeting. Right? By then, your data room is largely irrelevant. I can't tell you how many times companies will spend the vast majority of their time on the data and the data room and the underlying material, and far too little time on the perception before the buyer shows up and the first perception during a meeting. But that's how you hire people. That's also how you evaluate potential partners commercially, right? It goes to follow that a buyer would do the exact same thing towards you. Price taker or giver. So is the company able to increase margin as it scales? Or is it operating in an ecosystem where it has to give margin? Is margin given to it, or is it able to, quote, set price? Now, there's a huge opportunity on the continent particularly here, because companies at scale in a lot of sectors up to a certain size may be one of the only or maybe the only tech-enabled player in their particular space, in their geography. So while the market overall may set the price, their take rates have the opportunity to go up naturally. And there's a dynamic in Africa, I'm sure all of you will know, which is that it costs a lot more to get to a certain point because you have to effectively recreate the infrastructure. But then when you get there, your take rates can be materially higher than they would be in a place like India or Latin America. And so being able to chart the course for that in a thoughtful way can unlock a higher valuation at M&A. Basically, does the buyer believe that you're a price taker or price giver long term? Everybody projects higher take rates. The point is being able to chart the course of exactly how that's going to happen, but also very importantly, showing how it is happening, maybe to a lesser extent, even the company's current stage, and therefore people can extrapolate forward. Remember that buyers, unlike investors, almost always do a discounted cash flow valuation. They project forward 5 years with a terminal value and then discount it back. Not many growth investors actually do that as a basis for valuation. We only work on the sell side in M&A, so I can say this because we never work on the buy side, but there is an opportunity, which is what I call the compounding of optimism. Discounted cash flow over 5 years is nothing more than a set of assumptions projected forward. If you are showing slight uplifts in take rates, for example, and that can be projected forward, a buyer projects that for 5, 6, 7 years to much bigger numbers, very high terminal value, and the valuation today increases dramatically as a result, or at least increases significantly. But you need to be able to show enough evidence and point to the evidence happening. The reason is that those kind of up and to the right trends magnify because they compound. Now, a growth investor is never going to look at it that way. But buyers either choose to or have to do discounted cash flows. And so if you know what you're dealing with, you can help inform it. That doesn't mean do a discounted cash flow for the buyer. They'll throw it away. You have to help inform it so it becomes their valuation that you have your fingerprints on. And that is a very important aspect of getting to price. It's preparing to talk about price. Very few companies in an M&A situation actually take the time to do all of that and do it thoughtfully. But I can tell you that the ultimate price is driven out of all of this, not how great a negotiator you are once you get an offer. Oftentimes, we also need to understand strategic buyers, once they've gotten approval to make an offer, that offer doesn't move 50%. So you have to inform their thinking early in order to get the result that investors and management would be looking for. One other thing I'll talk about, because we can do this. I think I literally did this slide for an hour once in a class, so I'll save you all of that. Business model similarity to potential buyers. This is actually very interesting and very important. I'll give you an example. So years ago, many years ago, we were selling a business that sold to enterprise customers, and I think their product price was $50,000, right? Very logical buyer shows up, looks at the business, falls in love with it. Dig and dig and dig, and you realize that the buyer has a sales force that knows how to sell $5,000 to $15,000 product. They just don't know how to sell $50,000 product. They don't know the little consultative elements you need to sell at that price point. They are a volume sales force. Ultimately, the buyer didn't proceed because they just couldn't work out how they were going to push the business's product through their sales channel. What should have happened is actually, in that case, the seller should have proactively, early on, sat down with the buyer and worked out a go-to-market plan to leverage the buyer's own sales force, but adding additional resource. Now, that may or may not have worked, but understanding the differences between the target company's business model, how they sell, how they operate, and the buyer's business model, and understanding where the gap analysis is, means that you can guide a buyer early on to the point where they get comfortable to convert to doing a deal. I can't emphasize enough how buyers want to be led. They just don't want to be told. And so a lot of exit preparation, a lot of the dance before an offer is getting to a point where the buyer understands what they're going to do with the business day one. And I will tell you that half of that, on average, is actually driven by the seller. You just can't be seen to be driving it. And there's a lot we can talk about in the details. As I said, I've done 30 years of it. So, if you want to spend another 5 hours some point, we can do that. But, it also has to be customized. But it is so important. And again, this theme is laying the groundwork so that a high value offer is the last outcome, not the starting point for negotiation. That's how exceptional value deals get done. If we go to the next, there's only one other dimension I think we have time for here. Alliances, partnerships. Why is this important? Buyers buy companies that they know. One of the best ways that they know them is through commercial deals. One of the key focus areas of our work in exit preparation, a year or 2 years before a company looks to exit, is what kind of commercial partnerships make sense for the company to do that could naturally lead to M&A but in the meanwhile, don't compromise the company's independence or opportunity. There was I'm going to cover the one in the middle column top. There are many situations where a company will come to us and say, oh, we have an agreement with blank. Yep. And actually we have a go-to-market partnership and we're working on, how we can sell X or Y. And then actually we talk to the counterparty and they have so little invested. It's one of 100 things they've done. I'll give you an example. This is a very extreme one, not a company we worked with. There was a public company in the UK many, many years ago. I think it was called Made or something. And they made an announcement they had done a deal with Microsoft. Yeah, their share price jumped. You talk to Microsoft and it turns out that they do like 300 of these a year. It's like, I don't think they even knew the company, and so from that point of view, the situation was that, the company was simply using this for their own PR, not in order to actually generate value. And, if you don't have a buyer who is invested in a commercial deal with a company, then what you've done is irrelevant. And so this is the same theme of looking at it from the outside in. The other question that people often ask is, if I do these kind of commercial deals, could these be constrained on a future exit? Sometimes they can be. Apple, for example, just as usually their playbook is that a company that they're going to acquire has to cancel literally every contract with everybody before the deal happens. We've done 3 deals opposite Apple, and this is not anything that's confidential, but, and every single time the same playbook, you have to get rid of everything. So, that's an extreme example of wanting to have an unfettered run at leveraging the value and technology in business. But it's indicative of another trend, which is that if you've done a commercial deal with party X, it can either increase the interest from a competitor. Oh, okay, these guys have done I've done a commercial deal with my competitor. It's clearly proven that, the use case is of value, or it could create a problem. Devil's in the detail, but it is worth thinking about what commercial deals are positive and what are negative to a potential exit. And then there's the whole area on the bottom left of developing partners as potential buyers. The biggest issue here is the time sink issue. We've just gone through an exercise with AI-driven company in Europe that was being courted intensively by a Japanese company. And they've spent 6 months developing the partnership and also developing the potential as a buyer. The amount of time they've had to invest to get the Japanese company, particularly because they're Japanese and have to go through their own internal processes to the finish line, the opportunity cost is mounted. And so you really need to be sure that it's going to get somewhere. But there is a whole exercise around how to develop partners as potential buyers. The reason this is important is because probably half the time, certainly 40%, the highest price ends up getting paid by somebody who's already doing something with a company. It's actually relatively rare that somebody comes completely over the transom just in a process. Let's say we're running a 4-month M&A process. Buyer and seller never knew each other, and then that party converts to the highest value. It's relatively infrequent. And so a big focus of exit preparation is cultivation of potential partners, which takes a lot of different forms. That is something that relatively few CEOs actually spend time consciously doing. They sometimes and very often do it unconsciously. It makes sense to do this commercial deal. But what we oftentimes would do is say, well, okay, there's 5 or 6 commercial partnerships that are possible. Let's force rank them in terms of potential downstream M&A value. And the vast majority of the time, you reprioritize based on that lens. That doesn't mean that you're doing all commercial deals just for M&A, but it's very useful to just do that list based on M&A proclivity rather than just commercial rationale, and see how the 2 lists match up. You'd be surprised how they look. And then you have a conscious decision to make. Positioning is a question everybody asks about. And so I've used this example a couple of times. It's very old, which is why we can use it. Also, it's a UK-based business, so bear with me, anybody who might have seen this before, but people talk about, okay, how do you position a business? Well, you know, the key thing is, part of it is disaggregation, breaking the value down into its component pieces. And also, what do you, buyer, need to believe? On the left is a company that we had worked with many years ago. They presented their positioning to us on the left. Their gross merchandise value was $2 billion. They actually worked as a tradesperson marketplace, and they placed 1 million+ jobs. So they were a very active marketplace for these kinds of jobs, and we're at the middle of that industry. So from their point of view, that reinforced their positioning as a very important player in the market. On the right, after we've done some work, is the output of that, which, and I know it'll be a little hard for some of you to see some of this, but let me just explain quickly. First of all, the relevant first number is not 2 billion, it's 43 billion. And the reason for that, if you probably increase it, is that they operate in a home improvement market, of which the traffic on their platform is only a small subset. So the home improvement market is 40-50 billion a year, and about 2 billion flows on their platform. That GMV is very low. Their market reach is very low. And then you're looking at the value of jobs that are actually performed on the platform, the leakage. So only 20% or 25% of the value of the jobs are actually done on the platform. And then they, at that time, generated 14 million, but we're going to 20, I think, or something. So it may be relevant size for some of you here. And then the question was, okay, from that, what do you actually need to believe? Is the 2 billion naturally going to rise to some number? What do you reckon that number will be? Value of jobs on the platform, and then your revenue spits out of it. This is, to some extent, a market driver exercise, but very often companies do that at a very high level. And what buyers need is the roadmap. Right? On the left are the indicative numbers. On the right is the roadmap that you can build a story around. And what I said earlier about discounted cash flow feeds right into that, because the more you create a detailed roadmap of how you're going to get from X to Y, the more confident a buyer is going to be to project up and to the right. And also, I didn't mention this earlier, the lower their discount rate will be, because the lower their perception of risk, because you've done their work for them. So this is the kind of thing that, as a high value tech-enabled business looking to get sold for a strategic price, this is the kind of way that you can begin to inform how a buyer would think about valuing a business without doing a discounted cash flow for them, which they'll just ignore.
Victor, we've
Yeah.
got one question, and I didn't want to interrupt you because this is just
Please.
such an important slide. Just going back to partnerships, we've got a question from one of our Endeavour entrepreneurs, Aisha Pandor. In terms of partnerships, have you seen sellers specifically try to develop a partnership, proactively reach out with a potential buyer with an M&A in mind? And if so, how has that worked out, and any learnings you might have?
Emphatically, yes. the corporate development heads at reasonable sized tech-enabled companies, about 60 to 65% of them are also business development heads, i.e. they have the same person does both jobs. So in the majority of potential tech buyers or buyers who have tech valuations, the same senior person is responsible for key commercial deals as well as looking at M&A. And of course, there's a reason for that, because one naturally leads to the other. So engaging with him or her or key members of their team alongside a business unit is natural from a commercial point of view and naturally leads to a potential M&A discussion. It's actually a very high number. So as a guide, a target being entirely mercenary, that they're going to build relationships with companies that otherwise would make zero sense from a commercial point of view, would only make sense if there would be a buyer. That's a different category, but that's very rarely the case. It normally goes back to the prioritization of the 5 or 10 and how you'd reprioritize them. But you're pushing on an open door because the same person, more often than not, effectively does both jobs. There's a related question which somebody will wonder about: corporate investment. And since we did a corporate transaction and had corporate investment, I guess, and we've worked on a bunch of them, that's an in-between point. Yeah. So long as a corporate investor has 10, maximum 12 to 15% of a company, usually that's fine, because the negative control rights are by definition limited. It can put off other buyers. We actually have a case now where it's at the stage where other buyers are probably not going to be interested because they think, oh, so-and-so is going to buy it. So that's a risk, but it really depends on which sector. We think that on balance, it's worth seriously considering corporate investment, again, as a general point. And also, I think on the continent, because there are quite a lot of companies that don't have a big footprint on the continent. And one of the reasons they look to do deals, NI bought DPO because they had nothing in Africa. So that's one example. Stripe, by definition, other than Paystack, had nothing on the continent. So from their point of view, getting comfortable with a company as a platform is very important. And it's also unlikely, if they made a strategic investment, that they're going to have 12 other assets that you'd be in conflict with. So it can be a clearer roadmap to an acquisition. Plus, finally, it gives a degree of familiarity and therefore comfort with doing a deal in what would otherwise be a, quote, frontier market. I don't think I'd call the UAE or South Africa necessarily a pure frontier market. Neither would I call Kenya or Nigeria, but not everybody shares my view 100% of the time. And so the point is, get people over that hurdle to the extent one might exist. Especially people who are not involved in the deal and therefore, are evaluating it. It's just a way for them to tick the box. We don't think there's any, in the work we do in Europe, corporate investment, don't really need it. Market's fluid, everybody knows it, it doesn't matter. It's much more important in emerging markets. Of course, on the right terms. Should I keep going, Antonio, or any other questions?
Yeah, no, for now, that's great. Yeah, keep going.
A couple of other examples. Now, all of the examples are from Europe. Why? Because exits are only just starting to begin in Africa. So, and exit prep is literally just being talked about now. I don't think people talk about exit prep in Africa or the Middle East very much, if at all. By the way, even in Europe, we don't know of any other firm that actually does exit prep as part of their business, and there's reasons why, but it's just something we've gotten so used to doing that we do it for funds as well, because across portfolios and things like that, it's just the way we operate. But most people in our business don't like doing it because it takes a lot of time and it doesn't pay very well. It's just that we just see how you get higher price and certainty. So these examples are European examples, but there's absolutely no reason why they can't be adapted to anywhere. Yeah. There was a deal we worked on, I think it's 2018 or 2019. There was a fund in Finland. Next, they said it was their best ever exit. So you can read the detail, but let me distill the points. This was a company that did hardware and software for Wi-Fi design and planning and troubleshooting. The issue was that they were in quite a small niche. And also they had done almost no proactive marketing as a business. Almost nobody knew anything about them. Sound familiar? It should. We kind of turned it on its head, which is that the company entirely owned its niche. Yes, it operated in a niche, but they owned it. And so there's a degree of defensibility in that niche. Your standard thing about total addressable market, yeah, it's small, but the fact is the company actually owns it effectively. You also could position it as a pure software play. The hardware that they sold was incidental. And by the way, the read across is there are probably a number of people on this call who are running marketplace businesses or e-commerce businesses that are also doing logistics underneath, that may also be doing payments. And so there's a question of what business are you in? All of the above is usually a bad answer. By the way, you see that, for example, when you have fintech investors in Africa looking at and being very interested in fintech use cases. Why? Because they look at businesses through a fintech or payments lens. It just happens to be selling X or Y. Or indeed, a business doing e-commerce that's effectively logistics. You get the idea. So positioning it, in this case, was a pure software business, not hardware, which, by the way, was 180 degrees different than the way the company positioned itself. You know, you look at their site, it talks about the kit that they sold, which of course they didn't manufacture on their own. Again, nothing is wrong. It's just the company had to adapt its face to customers to tune it for its face to buyers. And the two are not the same. What we also did is we literally customized the positioning for every single buyer. So, and the question people had was, you know, how am I going to go from, I think it was 20 million or something of revenue, how am I going to go to 100? And that roadmap was different for every single buyer. So, I mean, in that case, we went back through earnings calls for every single logical buyer. We went through everything we knew about all those companies, et cetera. Won't bore you with the details, but the amount of work underneath positioning for particular buyers, I can't overestimate, and it just has to be done. I wish there was a shortcut. And by the way, this raises a point generally about M&A. People think that M&A is a distribution business, meaning who do you know at buyers or who can you reach at buyers? It is not. It is a product business. I mean, we can reach everybody. Anybody else in our business can reach everybody, plus or minus. It's the way you package the offering that matters. And it maybe shouldn't surprise anybody because distribution has become much easier over the last 10 or 20 years. People are able to be reached easily. It's what you offer them and the company as a, quote, product. And so, which is why we do so much work on positioning and so much work on customization, because you're tuning the, quote, product, if you will, towards each individual buyer. And it worked. A generic deck sent generically to 100 buyers, I guarantee you would have failed. I think also the company changed its website as well, which is another thing we do in exit prep. Not, look, if we work with any of you, it's not like we're going to completely change everything that you do. It's not that. And, you know, companies face the market is towards its customers, but there are certain things that you can do, and we'll talk about it in the next example, that are additive to that. By the way, the story towards 100 million of future revenue worked, and actually a growth investor was the second highest bidder, interestingly enough. So I guess that was proof in the pudding. But the company, so I tried to remember, I think I don't know if the revenue was reported, but it was a pretty high multiple of revenue. Much higher than anybody else had gotten in their space. So it worked. a couple of very thorny, we were talking about what quick examples to show, and we said, well, let's show the hardest ones, right? And then maybe talk on those, everything else is easier. So what do you do when you don't have a clear buyer? And yet you think that a strategic M&A deal makes sense? Pretty interesting question. Hopefully not relevant for any of you on the call, but it might be. So it's a bit of extreme. This is actually something we're doing at the moment, and there is an answer. The issue is that it's a software business that does, we're being very vague here, distributed software. Their natural buyer group actually are hardware buyers, big iron companies, think the biggest data center hardware providers, et cetera. And the reason that there's no buyer group is because none of them have any money, because that market has become so commoditized. And so all the people who would naturally acquire are effectively out of the business. So what we need to be able to, and nobody in their space has ever been sold. So it's not like there's an active M&A market. So what we're in the process of doing is positioning the business towards mid-size, when I say mid-size, it's 100 to a billion, software businesses that are selling in and around their space. Sorry to be vague, but obviously I can't really give any more detail. And also the company's products are able to benefit from the AI adoption wave because the compute power required for AI adoption among large companies is very high, and that wave is still coming. Most large industrial companies really haven't adopted AI. There's a secular trend, and also it really does enable edge and cloud connectivity. And so there is a roadmap to 50 to 100 million of revenue, which for a $300 million publicly traded company really matters. But they've never engaged with any of those. That's not their ecosystem. But their ecosystem has no buyers. So it's kind of moving the positioning towards a very different buyer group that they would never have engaged with before. That will be the ultimate, in our view, the ultimate buyer group. And it's a process. It's ongoing. Now, I'm a born optimist. For any company doing 20, 30, 50 million, 100 million of revenue, there's always a strategic buyer. You just have to think about it long enough. Then the next final one is kind of along the same lines. An e-commerce business that we've also done some work with recently. If you go to the next slide, sorry. If it's in the sports e-commerce space. And the issue there is there are some real buyers, but they are very cheap. So what do you do when you have a buyer group that's unbelievably cheap and you want to do a strategic deal? Well, to summarize all of this, on the right-hand side, you have to create an outer circle. The inner circle is 5 to 10 buyers. The majority of them probably single-digit EBITDA. The corollary in Africa is if you were looking to sell to a very traditional brick and mortar private equity firm in Africa, who could never imagine paying 15 times EBITDA for anything because that's the world they come from. Maybe that's one read across. Or a very traditional legacy player in the space. You need to be able to define the second circle, the outer circle. People who could leverage a business like this in a category, this case, sports e-commerce. And then again, the theme as before is you customize the positioning and the pitch to each one of those. And there's brand conflict and affinity and market, I don't go all the details, but if you're going to do it, you really have to do it the hard way, which is somebody one standard deviation away from a business needs to understand exactly and specifically how that business is going to be leveraged in their organization. And in a number of cases, what we have to do is front run objections. Billion euro e-commerce business say, yeah, I don't want to be in this space. Okay, well, actually, the reason that this space makes sense, in their case, for example, when you do sports, it's a male audience versus a female buying audience. And there are a lot of e-commerce sites that are predominantly female, and there's a lot of value to having a male cohort because they behave more like membership behavior, buy regularly. And that's a nice complement and de-risks a business from a predominantly female audience, just in terms of typical buying behavior, those kinds of things, where the value of acquiring a business like this, if you can see how it fits in, can actually add value broader within a larger business. Just some examples, right? But you see the handcrafting bit in a lot of this work, and that actually defines exit prep. A lot of it is this. Now, this is why I said almost nobody else in our line of business does this work. I guess we've been doing it so long that maybe it's become easier for us to do, but we don't do it just because we like to do this. We do it because you get greater certainty and higher price. The navigation, if you will, from African companies towards international buyers is also very specific, which is that you need to get on the radar screen of potential buyers. You need to build awareness, but also familiarity. You need to evaluate yourself relative to potential competitors that could be acquired. And you need to be able to position yourself in the minds of buyers, in the minds of 5 to 10 people within a buyer, that this is a safe company to buy, execution and future is safe, and you can build around it. If you reduce the discount rate and you can increase their discounted cash flow forecast, you have a strategic deal. If we go one or two further, so what are the biggest mistakes? I have a little more time. This is always a favorite topic of people on a call like this. Like, over 30 years, what are the single biggest things that I've seen happen repeatably? Some of these take off from previous slides. CEO says, I really know how to position my business. We look at it, and it's looking at it from the inside out, makes sense to them and their board, but is not the way a buyer wants to look at it. More complicated. Buyers pay more for simple. They pay less for complicated. They pay a lot less for inside-out positioning because it can't resonate, doesn't resonate with them, doesn't matter to them. Fit, you can read the words. No one cares about a $10 or $20 million business, pretty much anywhere. I don't mean it in terms of investors or CEOs. It would be a privilege to build a $10 or $20 million business to scale, only looking at it through the lens of M&A. They want a $100, $200, $300 million business unit. If you're 50 million of revenue, you're still in this category. Brand. Corporate marketing. Probably the single biggest mistake that CEOs make is to spend too little on corporate marketing, which is not PR, but building awareness of the value of the business, building the perception, so that perception minus reality is a big number. I gave one example, I think a year or two ago in one of these workshops, forgive me for repeating it, but decades ago now, there was an email company called Hotmail. And some of you probably still have a Hotmail address. Hotmail did one kind of corporate marketing, which is they got into public company analyst reports who are writing about publicly traded email vendors. That's when publicly traded email vendors actually were a thing. I know it sounds like, BC. There were 7 or 8 publicly traded email vendors and Hotmail, which was private. CEO of Microsoft was reading analyst reports, looking, and they want to get into the email business, looked at it and said, who's Hotmail? $400 million later, they bought Hotmail. Private company, almost no revenue. Yeah. That's corporate marketing of a certain type. I'm not proposing that's something everybody should do, but getting that kind of visibility with buyers, and you can't do that if you're trying to sell the company in an M&A process or anything like that. You cannot do it. And then the final one I think we've covered about engaging with buyers. 1 to 2 years ahead of when you want to have an exit window, when you want to be exit ready. And that's how you get bought, not sold. The proportion of CEOs that do all of these things well in Europe and the US, 0 to 5%. Asked to do a couple of slides about us, so I'm going to do that and then may take questions. We've done a fair bit in Africa, as some of you will know. What's more interesting for us right now, we've got now 6 active rounds above 25 million of equity each and 3 active M&A deals above 50 million on the continent. We think we're probably doing 1 out of every 2 or 1 out of every 3 rounds of that size being done. I don't think there's more than 15 or so, but I could be a little wrong. They're not many. And we certainly are seeing an uplift in M&A and control deals for good reasons, companies that don't have to sell. But see the dynamics we talked about earlier. If you're ready to sell, it's too late to prepare. I think
Victor, I've got a question that's come through, and maybe it's not relevant for this market, but certainly we're seeing, you know, the rise of SPACs. And so I'd love to hear your views on a SPAC versus an exit. It had to be asked, and maybe just talk through the typical reasons of why, you know, the SPAC has kind of come about. That'd be helpful.
Well, it's come about because it can. It's a perfect feature of a frothy market. I mean, raising public blind pools so that people who should be thinking 3 times about participating in instruments like that don't. There's nothing wrong with it. That's just indicative of the froth in the market overall. We're starting to see a little bit from SPACs in the work that we do. It's not a big feature at the moment, although companies are doing reasonable sized deals through SPACs. I mean, what do I think about it? It's a higher value funding round. I'd say it's kind of similar to, because, you know, you have to be suspect about the liquidity you actually be able to have going through a SPAC. I mean, you know, in NASDAQ, you need to have a market cap, certainly $1 billion plus, in order to have any real liquidity. And in London, as many of you know, if you're on the AIM market, you have almost no liquidity, and you need to have a certain size in order to really use the public markets proactively. Otherwise, it's a quote and a fairly efficient way to raise money. Don't prepare for a SPAC. Prepare for the other alternatives. If a SPAC shows up, okay, it's a left field option. It doesn't change anything that we said, and it could be gone like Bitcoin prices and other things, and it could be gone in 6 months or a year. So.
Yeah, it's very interesting just watching the trends in the public markets, as you say, indicative of where we are. Just looking to see if there are any more questions coming through. I don't see any on my side.
I think there was a question maybe earlier about partnerships, developing, maybe that was covered already. But I'm happy to take other questions. I wanted to finish a few minutes early, just respectful of everybody's time.
Just a question, you know, kind of summing up a lot of it, there's just so insightful around, you know, the intangible, you know, of perception throughout the whole time, you know, because that, you know, you say you should only plan 1 year ahead before doing a deal, but something like a perception, it's just an ongoing thing, isn't it? You really are doing that from inception of your business values right from the start, and it's just so that's so interesting. And another thing, you're thinking of the business model, because that just doesn't start, you know, 1 year before. That's something you're thinking of the whole way through, and so valuable to really think about how you create value by doing that business model. And partnerships and is another thing is ongoing, and competitors. I'm just wondering what advice you'd give. Is it helpful to really really get to know? I mean, you would anyway if you're in the business of a certain sector, to getting to know your competitors really well.
Well, so two separate comments. The first thing is, for people who are trying to put this kind of approach into a purely logical context, just a note to bear in mind. Somebody told me years ago, and I've never forgotten, he said, people don't remember what you tell them or even what you do. They remember how you make them feel. And while to some people it may not be natural to look at it from that point of view and try and put it into a logical framework, a lot of this is the impression, the perception that buyers have before they show up, how they feel about this is a good, you can't think how many times large companies say, I think it's a good business. They know nothing about the business, right? I think it's pretty solid, right? Yeah, they're really going somewhere. I have no idea. That's a strategic deal in the making. The other point that you were talking about, Antonio, I wanted to get that point across, but you were talking about the preparation piece and the perception piece particularly. And if you're running a business on the continent, you have to oversteer on the dimensions that I talked about earlier. You're further away. You're less visible. Africa, Middle East is not the #1 market for anybody, in quotation marks, but it's interesting. You get a lot of tire kickers, people who are kind of intrigued to learn and aren't really going to pull the trigger to do a deal, et cetera, et cetera. So that means that there's even more value to what I call oversteering, more preparation, more intensive awareness raising, more awareness of the anchoring those perceptions among buyers, but also qualifying companies who are real rather than just interested to learn. About the competitor point that you raised, let me quote disagree with that for a minute. It is really surprising to us how often companies know so little about their competitors. CEO will say, oh, I know them, and then proceed to tell us something that we know was what their competitor looked like a year and a half ago. But under the hood, because we've talked to them, we know they look different today. The reason is you get up in the morning, especially in Africa, Middle East, something's always going wrong. There's always something you have to deal with. Right? Your mind and your energy is consumed by the problems of the business. I accept you don't have time to go study every competitor in detail. And so usually there's a degree of ignorance about competitors that's greater than you think that it is. And oftentimes companies that we work with learn more about their competitors through buyers who've talked to them than they do directly. So being aware of what your competitors are doing is great, but just don't underestimate your level of ignorance. That's more true than not.
That's great. And Victor, we've got one follow-up question just from Aisha in Swiss South. With both fundraisers and exits, how are both sides positioning impact and recovery from a pricing point of view? We saw some predatory behavior around mid-2020. Is capital becoming more balanced? I think that's maybe is that a South African context, perhaps?
Yeah, there may be a microclimate in South Africa for a period of time as a result of all of this, and it also in other markets. That's one point. But if I set that aside, we are surprised at how little predatory behavior there is, generally. Incredibly surprised. We had expected that investors would be putting more structure in rounds, left, right, and center. Buyers would be a lot more cautious, not looking at the continent. You know, when Europe and the US catch a cold, you know, Africa goes to the hospital bed, right? And so we'd expected, honestly, if you asked me 6 months ago, I'd have said there'd be no M&A for 2-3 years on the continent, and fundraisers are going to dry up for a period of time is kind of what it looked like. Not because I was Chicken Little, but just because you just looked at that kind of pattern recognition. The reverse is true. There's more interest from more large round investors and more M&A and strategic interest now in Africa and the Middle East than we would ever have expected. Funds that have never invested in the region are looking at it. This is not, and those of you who know me know, this is not a good time, you know, oh, everything's great kind of speech. I don't say this lightly. We are the more surprised than anybody that we're doing this much work on the continent and where people are seriously engaged in putting money to work on the other side of the table. No one is more surprised than us. So I genuinely don't think that the pullback that we above all expected is materializing. Which, look, of course, the other side of me says, okay, you know, let's take advantage of it while it's like this. You never know what's going to happen. But it really is surprising. Antonio, there's a few other questions I think that were raised. We have a couple more minutes, so I'll leave you to decide what to raise.
Yeah, these are actually questions that that we've answered. I probably just haven't clicked them off, but yeah, that's thanks from Aisha in terms of the last question. And yeah, I don't see any at present. Yeah. No
problem. Well, I'll just leave you all with one thing, which I mentioned earlier, just to reinforce, is that the exit preparation at the end of the day is about getting bought, not sold in a process. Because once you're in a process, you can't prepare anymore. Getting bought, not sold means that there's buyer interest intensity. Buyers are driving the process. You're reacting. It's a little chaotic. You're trying quickly to get other buyers into the frame. It's all moving quickly. That kind of energy in an M&A process, and then a deal converts, and it's much more often than not at a strategic price because you get that dynamic. To create that dynamic, which is what everybody on the sell side in M&A scenario wants, requires, as I said, a lot of pre-selling. We don't call it selling. And the work we do on exit prep is not write a book and send it to people. As I said, that's an M&A process. You don't want to be doing an M&A process. In fact, very interesting, there's a very small number of M&A processes we run where we actually write a book. That's a good way to get sold, not bought. So by the way, I think, Antonio, there's a whole nother session on actually running an M&A process for maximum value, not preparing for it. So that book's also not on Amazon, so you'll have to do it through maybe a webinar, but you know, the whole set of things. But before you get to that point, you've got to get this right. And that is done over a period of time quietly. And it works. Believe me, it works. I think we can close there. Yeah, let's hope we get into that situation soon in Africa. That's super exciting. Victor, so wonderful to have you. Thank you very much. Thank you all.